The most successful hedge funds in the world do not buy stocks when they are breaking records. They wait for a sudden tech panic or a sudden regional sell-off to snatch up high-quality companies at an absolute steal. Right now, a targeted correction in specific sectors has left exactly 5 powerhouse companies sitting at a massive discount. These are not speculative penny stocks destined to crash. These are cash-flowing giants with solid moats that are mathematically primed to rebound over the next few weeks. What most people do not know is that the fastest way to lose money right now is blindly following the crowd into overhyped AI names. Instead, smart money is rotating directly into our first massive opportunity on the dip. This brings us to a major global player in tech infrastructure that just suffered a temporary blow. We are looking closely at Advanced Micro Devices Incorporated, trading under the ticker AMD. AMD recently hit a rough patch after a broader sector rotation dragged down high-tier chipmakers. Retail investors panicked and sold off their shares, but institutional buyers are quietly loading up. If you look closely at the actual hardware, AMD is aggressively capturing market share in the massive data center ecosystem. Their new AI accelerators are undercutting their primary competitor, NVIDIA, on price, while matching them on raw performance metrics. While NVIDIA trades at an astronomical valuation multiple, AMD has dropped to a highly attractive forward valuation. Before you skip to the end of this list, realize that AMD is also beating out Intel in the traditional server market. Intel has been plagued by manufacturing delays, which leaves a massive vacuum that AMD is filling rapidly. The market has incorrectly punished AMD for general tech volatility rather than looking at its individual execution. This mispricing creates a beautiful short-term window for a sharp trend reversal as upcoming corporate earnings approach. The surprising part comes next because this next stock is not even listed in the United States. We are heading across the Atlantic to look at a dominant fintech giant in the United Kingdom market. This is Wise plc, trading on the London Stock Exchange under the ticker WISE. WISE operates one of the most efficient cross-border payment networks on the planet. The stock has dipped recently due to general weakness in the European financial tech sector. However, the underlying business financials are growing at an incredible pace. WISE currently has a fair value upside estimation of over 26% based on institutional analysis. When you compare WISE to its traditional competitors like Western Union or mainstream legacy banks, the advantage is overwhelming. Legacy banks charge massive hidden fees and take days to process international transfers. WISE completes most transfers instantly at a fraction of the cost. They are pulling millions of active users away from traditional banking institutions every single quarter. This structural shift means their revenue stream is incredibly resilient. The stock is coiled like a spring, and a minor volume spike could send it back to its true value very quickly. This brings us past the halfway mark of our breakdown, which is the perfect time to make sure you are positioned for daily market updates. Hit that subscribe button right now to ensure you never miss our urgent buy alerts and deep dives. Now let us shift our attention over to the mainland European markets for a massive healthcare giant. We are talking about Sanofi SA, which trades under the ticker SAN on the Euronext Paris exchange. Sanofi has experienced a noticeable dip over the last few trading sessions due to temporary regulatory noise surrounding its product pipeline. This is exactly the kind of short-term noise that savvy swing traders look to exploit. If you compare Sanofi to its direct European competitors like Roche or Novartis, Sanofi presents a far more compelling value proposition. Sanofi possesses an absolute golden goose in its immunology drug called Dupixent. This single drug is generating billions in cash flow and continues to expand into new medical approvals globally. While competitors are facing steep patent cliffs on their core products, Sanofi has a refreshed portfolio that secures its revenue for years. The market is pricing this stock as if its growth has completely stalled, but the exact opposite is true. What most people do not realize about the pharmaceutical sector is that sentiment flips instantly. The moment the market shifts focus back to steady cash flows, Sanofi is set to catch a massive wave of capital inflows. Our fourth stock brings us right back to the United Kingdom, focusing on a massive consumer business that is currently trading at a deep discount. This is Associated British Foods plc, trading under the ticker ABF on the London Stock Exchange. This company owns a massive diversification advantage because it operates a huge food production business alongside the massively popular retail giant Primark. The stock has pulled back slightly due to brief concerns over retail foot traffic in Europe. If you compare Primark to its main retail rivals like H&M or Zara, the competitive advantage becomes immediately clear. Zara and H&M have raised their prices significantly over the past 2 years to combat supply chain inflation. Primark stuck to its ultra-low price model and has seen a massive surge in volume from budget-conscious shoppers. Furthermore, their fast-expanding footprint in the United States market provides a massive long-term growth lever that the market is completely discounting today. Buying the dip on ABF gives you a highly defensive value stock with an explosive retail catalyst attached. The final stock on our list is a household name in the United States that has been unfairly beaten down by short-term retail trends. We are talking about Lululemon Athletica Incorporated, trading under the ticker LULU. Lululemon has had a highly challenging year, dropping significantly from its previous highs due to fears of slowing growth. This has turned the stock from a market darling into an absolute deep value opportunity. If you compare Lululemon to Nike or Adidas, Lululemon maintains a far superior operating margin and brand loyalty. Nike is currently struggling with structural innovation issues and management transitions, leading to a massive decline in wholesale demand. Lululemon operates a highly lucrative direct-to-consumer model that keeps their margins incredibly high. They are successfully expanding their men's product lines and rapidly growing their footprint across international markets like China. The market has priced Lulu as if the brand is dying, but their core consumer base is still spending heavily. This massive gap between perception and reality is exactly why the stock is primed for a sudden and powerful upward correction over the next few weeks. Make sure to look out for our next video posted daily to stay ahead of these rapid market movements.